I've always tried my best to spend money wisely. I've saved, searched for discount codes, and researched new products for days on end before committing to a purchasing decision. Sometimes it's been more hassle than it's worth, but over years of these little efforts, you start to get clarity and see the best actions more clearly. I think I might have achieved my first big money milestone in December of 2021 when I finally decided to pull the trigger on an investment I had been looking into for ages. It was daunting because I wasn't sure how it'd turn out, and I didn't have a clear goal or expectation other than wanting it to turn a profit. The platform was Vanguard, and I'd seen all the personal finance creators I looked up to praise this platform for its accessibility and low fees. I decided it was time to join the club, and I invested £275 of my own money. Before I start talking specifics, please know that I'm not a financial advisor, and this isn't financial advice. Your money is at risk when you invest. Thanks for listening. Now back to the video. Out of my initial investment, £175 went into the Life Strategy 60% equity fund and 100 into the US equity index. This was the first step, but over the next 4 years, I would repeat that same action 41 more times across many different funds, always investing more each and every time. Month in, month out, I returned. I was doing something called pound cost averaging, which meant that the ups and downs of the market were evened out a little bit by me topping up my account. But even with me drip feeding more money, the progress in the overall portfolio was slow. I had a rule for the first few years that I would auto-invest my income. This is the best way to remain disciplined, in my opinion. The budget was set and the account automatically collected my allocated spare income on payday. Living on less than I made was key to this because it let me allocate the money to invest without causing me to worry about the short-term result. And speaking of the short-term result, initially, my investments didn't really add up because the value on my portfolio was less than what I'd put in. This was because it was a bear market at the time, and during 2022, my first full year of investing, the US stock market fell by more than 20%. In fact, looking at the performance, it was the worst year to invest since 2008. Typically, when stocks are down, bonds go up. That is to say, they tend to have an inverse relationship. I had decided not to go all in on stocks, but keep a proportion of my portfolio as bonds. In theory, this would take some of the sting out of any losses from the stock portion of my portfolio. And with that, you might think I was safe, or at least safer, but that isn't really how investing works. With investing, there's no rule or guaranteed outcome you can rely upon because you are quite literally risking all that money to be in with a shot of obtaining a reward where it ends up being worth more than what you paid in. In year one, I was rewarded with the global downturn, resulting in significant losses across both stocks and bonds. Looking back, it was amazing that I was able to keep consistently placing hundreds of pounds into a falling economy. But whether it be because of my ignorance or my stubbornness, I just kept going. Actually, a big reason why this worked out was knowing that each time I bought, I was buying at a lower and lower price. The fact that I had set aside so much of my monthly salary to invest made it an easy thing to keep doing, and the value for money of what I was buying seemed like it was getting better, not worse. The more the fund value fell, the more the same amount of money would buy me. See this example where in December 2021, I was able to buy 1.277 units of the US equity index fund for £100. And then by March 2022, the amount I was buying for the same exact money had already increased to 1.305 units of the same exact fund. By the way, units are what you buy when you invest into a fund. It's essentially your slice of the overall investment. So instead of owning each individual share or bond, the fund owns these for you, and then you own a part of the fund. As much as it stung to see the losses on my account, I had the long-term result in mind and couldn't help but think that if I just stayed patient and kept investing, the results would be worth it one day. I didn't know when exactly, but I felt things would eventually go my way because of compounding, which is how money ends up making you more money over time as you start to earn interest not only on what you have directly paid in, but also the money made in the process. I invested £4,736 in year one, £6,450 in year two, and £9,825 in year three. These were all split across monthly instalments when I got paid. The contributions were all from savings out of my salary and were all planned as part of a monthly budget, which would be revisited each time I got a pay rise, an annual bonus, or surprise payments such as money for birthdays or Christmas. And while I kept challenging myself to invest as much as I could, I also balanced this out with other things. So I kept space in my budget for little luxuries, calling it misc money, in case I wanted to buy myself something as a treat. Another high priority area for us financially was overpaying the mortgage. There's a lot of investors who believe it's not worth overpaying on your home repayments because it tends to make you less money than it would by buying into the stock market. But in my case, it's not just about being as rich as possible. It's also about taking on a level of risk that feels comfortable to us and allows us to sleep at night. By us, I do mean me and my fiance, Nick. We live together. Also, while on this topic of saving and investing, it was our exclusive focus to save for a good 3 to 4 years before we got to the point where we started investing. All this to say, it's not something that can always happen overnight. It's something that, as I think I said at the start of this video, can build up from repetitive actions until you become familiar with your own spending habits and start to recognize what truly brings you the best value. By 2025, I had recognized investing to be providing the best value for my money. Overpaying the mortgage made us feel freer every day because we slowly owned more and more of the roof over our heads. This was safe and certain, but investing had the allure of unlimited potential with even greater returns. So in 2025, when I received a big payout from some fixed term interest savings that we'd built up over our years of saving, I decided to invest my portion in one go. This time I did a few things differently. Firstly, I went into 100% stocks. While it's a good idea to split your money across different asset classes, I felt comfortable not hedging between stocks and bonds this time. I decided to diversify in terms of selecting a global fund that would provide a tiny piece of thousands of companies across the world, including developed and emerging markets. I also chose not to bother pound cost averaging because I had the money ready to go. Unlike before, when I was waiting for my monthly salary to come in, this money was all ready to work straight away. I don't think I'd have had the confidence to do this back in 2021. So I do think it also shows just how much the first 3 years of investing have helped me to grow. The final change I made this time around was the platform. While I still do like Vanguard, and I think I always will because of the nostalgia of those first few years, lately it's become more expensive, and so I picked a different platform called Trading 212, which is a more cost-effective way for me to invest because it charges 0 platform fees. An extra £20,000 invested on the Vanguard platform would cost between £30 and £50 extra per year. So we're not talking a huge amount, but it's something that can be entirely avoided on one of the newer platforms. Choosing the platform is one of the most important decisions you'll have to make when you start investing. So I've popped my quick comparison guide below the video that is free to download and use. The 20k lump sum investment actually ended up making more than a 10% return in just 6 months. I also did a full video update on this specific investment, which I'll link in the description of this video too. One of the main downsides of changing platforms is that you lose your historical performance data. Those are gold mines with years worth of lessons that are really valuable. Luckily, I have it all aggregated on my investment tracker spreadsheet, so I can still provide accurate updates despite the platform change. I'll link the tracker in the description along with the other resources. It does have a small cost, but you'll have lifetime access and it can track up to 10 separate investments, such as individual portfolios, funds, or stocks all on the same sheet. And if you do choose to purchase it, thank you so much. It honestly does mean a lot and it helps me keep this channel going. But if you don't need it, then don't worry, as just dropping a like, sharing this video, or commenting below would also make my day and help me keep creating videos just like this one. Going back to my 4 years of investing, once we add up all the 41 payments into my stocks and shares ISAs, we reach a grand total of £41,275 that I have personally invested. And as for the value part, it's currently valued at £50,923. To put that into some perspective, it means that for every £5 in my portfolio, £1 has been generated through investment returns, or in other words, completely passive growth. It also means I have invested £842 per month on average over the past 49 months, returning as well an average of £197 per month along the way. The annual rate of return across my portfolio is 14.9% so far, and it's far higher than the current mortgage or savings rates, which are around 4%. But I understand that it can be overwhelming to start, so if you're a beginner and want some personalised guidance, you can book a call with me to chat through your options. The link is in the description. As you can probably tell from this video, it took me a very long time to decide if I was ready to invest, plan my expenses, choose the platform, and build up the confidence to start investing. I can only imagine how much further along I would be today if someone was there to help guide me through the process. This is a new service I'm offering to subscribers through the link below, and it's all done one-to-one, and so you will get the chance to ask all your burning questions on a face-to-face session with me via Google Meet. There are limited slots available, so I recommend you do book in a session if it's something you are keen to do. I hope you've enjoyed this little breakdown of my investment returns over the past 4 years. If you've got any thoughts about this video or what you'd like to see next, please drop them below. I still am reading each and every comment and reply to 99% of them, so I promise I will see it and genuinely appreciate you taking the time to give me feedback. Otherwise, have a great week ahead and I'll see you in the next one.